Thanks for tuning in to Corcelli's review of world financial markets and economic happenings. It's Friday, July 29th, 2016. Just review of the most important things that have happened. U.S. durable good orders fell more than expected this week, going down 4%. If you take out the notoriously volatile commercial aircraft category, we see it down 0.5%, which is not as bad as considering that. We also see that GDP came in weaker than expected, weaker than most economists had forecast. The forecast was for a 2.5% increase. It came in at 1.2%. And that leads us to believe that the economy is a little bit weaker than most economists, at least, had expected or thought. If you throw inflation into the equation, the decision, you start to see that the economy is stagnant. May we be at the point of stagflation? Possibly. With negative interest rates and monetary stimulus galore, a stagnant economy is very unusual at this point. Governments around the world are opening their checkbooks and they're starting to consider and contemplate fiscal stimulus. Japan announced this week a fiscal stimulus package worth over $200 billion. Turning to China, China stocks came into focus this week, and not in a good way, because Chinese regulators have considered additional regulation on wealth management firms to stop capital flows in and out of the stock market. On the earnings front, Credit Suisse reported earnings better than expected. However, the earnings this year are lower than last year. Not good for a company, especially the size of Credit Suisse. But that's been the tale of the quarter, as Wall Street guided earnings down on most companies at the beginning of 2016. And that's why I think the market got off to such a bad start in 2016. As a matter of fact, it was not one of the worst. It was the worst start in the stock market's history, down 12% in just January alone. Now, halfway through, the year, and over halfway through earnings for the second quarter, we see a lot of companies are beating their estimates. However, you have to look at and take a little bit deeper dive. And let's take a look at Apple, for instance. Apple's earnings came in better than expected, but if you compare them just to the beginning of the year, you'll start to see that the estimates have been revised down sharply, and because they were revised down sharply, Apple now beat their earnings. An outlier to this phenomenon is Facebook. Facebook's estimates were never revised down. They were actually continued to be poised to go up, and Facebook not only hasn't had downward guidance on their earnings were increased, and they beat and exceeded the estimates on EPS basis as well as top line revenue. Those people at Facebook are doing something right. Maybe it was Instagram that they bought that's driving things so far. We can't end the week without talking about the UK and the European Union. Brexit is wreaking havoc on the EU and on growth, and we see a slowdown in the data this week. We've published some stuff through Twitter. We've put it on our Facebook account. The European Union, even with these massive quantitative easing measures that are being undertaken and low yields, much lower than the U.S., GDP is not really growing at a faster pace. It's actually decelerating. And this number was taken before Brexit. So imagine what it's going to look like after. Please expect continuing, deterioration of conditions, both in the UK as well as the EU. Most economists are predicting a recession in the second half of the year for the UK. Anyway, I hope this was a great week for you investing. The S&P 500 is, at historic highs, weakening macroeconomic data, weak earnings that are, more of a sleight of hand than real beats. How much longer, how much higher can the stock market go? I just don't have the confidence in it right now to back up the truck or even add to any positions. So with that, have a great weekend.